G'day everyone, and welcome to FinChats. My name is Hugh,
My name is Hoy.
and today we've got some very exciting developments in central banks around the world, actually. So, as of last week, we've had both the ECB and the Federal Reserve both raise their interest rates to record highs. So, we have the Eurozone raised their deposit rates 25 basis points to 3.75%. And the Fed also hiked another 25 basis points to a target range of 5.25 to 5.5%. So these are quite high numbers, and we've been following this development since the tightening cycle. But what we've seen actually around the world is quite good news. Headline inflation has been coming down from peaks around these developed economies. So we're seeing disinflation, which is a positive trend. But on the flip side, a common thread as well is that core inflation is actually quite sticky. So core has different definitions across these economies, but essentially it will strip out the measures of volatile, price items like food and energy. So what we see is that level of inflation is still quite high, and it's predominantly in two sort of categories, being services and rents. So I just wanted to maybe talk about a few upcoming decisions that we have next week. So we have the UK Central Bank releasing their decision, as well as the RBA. So perhaps if we want to talk about, let's say, what the RBA, decision will be leaning towards to Hoy, what do you sort of envision, given these recent developments that we've seen with, the US and the ECB rates? Do you think that the Aussie Central Bank, the RBA, has an inclination to follow the buck, or do you think Low and Bullock are a bit more on the dovish side?
Yeah, well, the market expectation is that, what the market hope is that they will have a pause, but inflation, as you mentioned, headline inflation is going in the right way. It's trending down. It's, I think, come off a high from December of more than 8%. If my memory is right, it's 8.4%. Now it's down to 5.4% in the June quarter. So it's certainly trending down, and therefore the market voices, the market analysts and commentators are saying, well, surely isn't that enough for it to pause interest rates? Now, the spanner in the works perhaps might be, as you kind of alluded to, is that Philip Lowe, the current Reserve Bank of Australia, the RBA governor, is also going to step down in mid-September. So he has had a history of recent months of hiking interest rates, but um, the question is, will he increase one more time before he hands over the reins? Not sure, but I'm sure he'll take a more objective approach and looking at the data. And the data, so far at least, is that it's trending in the right way, and therefore the market expectation is for rates to be on hold. That's our hope. Certainly for mortgage holders, people would like some relief in interest rates.
Yeah, I definitely echo most of those points. Like, I think that, um, you know, if I look at the RBA minutes that came out a few weeks ago in early July, there are a lot of dovish tones within those comments. So what the conclusions were from those minutes was that they did think about two cases, with one being a possible increase in rates by 25 basis points and the other one for a pause. Ultimately they said that there was stronger cases for the pause, and that's because a lot of the leading economic indicators were pointing towards a material shift in economic growth downwards. And also, interestingly, last week we had Aussie inflation numbers come out, and within those numbers, consumer spending, which is defined, quite broadly across different categories like retail spending, clothing and whatnot, that actually fell down 0.8% in the June quarter. So that's a negative number. And so that is quite a positive sign, I guess, for the RBA to lean towards a pause. Having said that, I think, as you said, we are on very tight lines here. Like, you can always make the case that core inflation, services, and rents are still quite sticky, and the RBA has acknowledged that. And so markets are, really debating whether the RBA is going to go up or remain. So for me, I really don't know. I don't think many economists even know what the RBA will do, but it will have consequences for mortgage holders as those fixed rate loans sort of roll off into variable. And I think that the UK has similar situations. Hoy, is that right? With I think that majority of UK mortgage holders are on variable rate mortgages rather than fixed.
Just before I go into that, just on the point about the Australian, CPI has gone down. It for goods at least it has gone down. For services, inflation for services, as in price for services, has gone up slightly. So I don't think it's enough to call for a hike in the interest rate. It's if I remember correctly, the services inflation or the amount of increase in services prices has gone up from 6.1% in the March quarter to 6.3% in the June quarter. So slight, but it's enough to be one of the highest annual increases since the GST, the Goods and Services Tax, back in 2001. So I don't know whether that's enough to increase rates. I don't think so, but just another complexity within the CPI.
Yeah.
So CPI is made up out of a lot of factors, and that's just one of the data points. In terms of your question about the UK cycle, I think
Yep.
yeah they also need to um, look out for increased rates. Their inflation issue is a lot more pressing than Australia, and it seems more pressing than the euro as well as the US. They've got persistently high inflation, and it seems like the next meeting, which is next week, the 3rd of August, um, most analysts and commentators are betting on another quarter point increase. So it is a issue as it is in the major economies still.
And what do you think about the UK Central Bank's recent appointment of Ben Bernanke onto their sort of that team, I guess, to reassess the methodology of how they forecast inflation? It was, I think, released last week as well, just fresh off the press, that they have been using the same models for about 3 decades or so to forecast inflation. Why do you think Bailey at the UK bank has got Bernanke on board? What is the, I guess, what's the thought behind that? Is it going to
Yeah.
assist in the tackle against inflation? Is that pointing towards them falling behind other central banks in their fight against inflation? Just keen to hear your thoughts on Bernanke's appointment.
Yeah, if Bernanke doesn't seem too familiar with people out there, or maybe it does, and you just can't pinpoint the name. Ben Bernanke was a former Fed chair, so at the moment the Fed chair is Jay Powell, but Ben Bernanke was in the hot seat about a decade ago, if I'm not wrong. So as you say, the Bank of England has invited him to review how they forecast inflation. Because one of the criticisms of the Bank of England is that, well, they haven't done a great job in managing inflation, but not only that, the communication of that is pretty poor. So, in terms of one of the tasks of a central banker is not only to set rates, but also to sort of give indicators to set market expectations.
Mhm.
So, about where rates might be, could be, should be, etc. Now, they use the vaguest words, but they don't want to surprise the market, right? Um, so if I go back to one of the criticisms of the Bank of England is that they haven't been communicating that well as actually forecasting inflation that well as well. So I think Ben Bernanke's appointment is to solve both these issues, not only to forecast it right itself, which is a technical task, but
No.
also how do we influence, how do we communicate, how do we set market expectation through communication, through increased transparency, etc. Now, one point that you brought up was that the 30-year-old, 3-decade models, which I found fascinating. Excuse me, fascinating, not in a good way. It seems to suggest that the chief economist at the Bank of England was saying that, well, you know, anyone who's using 30-year-old models, it's inevitable that we need to change our models. So, this appointment is great, and he's trying to. Well, my reading of it is that he's trying to spin it in a positive light, which I think on the surface, I just accepted it. And then when I sat back a bit and went, hang on, you've been using the same model for 30 years? I mean, even where I work, and I'm sure where you work, you would tweak models, you would update models with every, significant event or, at or when you have different hypotheses, etc. So it just astounds me that if they've been using a 3-decade-old economic model and haven't updated it, I'm like, wow, this is supposed to be the premier bank in the country that should have the latest, modeling techniques and best and brightest, etc. So that's my rant. But in a nutshell, Hugh, I think increased transparency, which is what they're going for, and better forecasts of actual inflation will help the community more because, or it will help us better because you know interest rates impact real people's lives.
I think on the transparency front, like that's been a wider development that I've seen across some central banks, and I think it's become ever more important because inflation is starting to become a bit more entrenched. Long-term inflation expectations are, quite higher than it was pre-COVID. And example of this is with the RBA. So going forward under Bullock's reign and her term, they will move from 12 to 8 meetings, so once every 6 weeks instead of once every month. And on top of that, they will hold a press conference similar to what the US Fed is doing. And the point of that is really on, to improve transparency and communication. It's really to ensure that market expectations of inflation is set forward so that businesses, households, etc., can dictate what their spending and investment patterns will be going forward. So that's just a little development that I've sort of witnessed that other central banks might be doing. It doesn't have to be that way, but they are working towards unifying transparency on central bank developments and inflation expectations. But
Yeah.
I just wanted to,
Interest
yeah,
interest rates. Whenever we hike interest rates, or central banks hikes interest rates, no one likes it because who likes to pay more on their lending, on their goods and services, etc., etc. But the more transparent central bankers are, or the more indications that they can give about what their movements are, the more families and people at the kitchen table, so to speak, can actually prepare that. You know, people can people often go to the bank to get a loan based on the views of central bankers. If they think that interest rates are not going to increase for the next year or so, people might be satisfied to get a loan right now. But if that's not the case, then it may have negative impact to people. So increasing transparency, increasing communication with the community can only be a good thing, in my opinion.
And just on the, I guess, implications of these interest rate rises. So we've talked about a lot of the implications for households and consumers in terms of higher mortgage repayments eating into people's wallets. What about, I guess, the impact for banks? Surely it's a good thing, right? Like, do they make more money or,
Well,
yeah.
generally, when the central banks raises interest rates, its official interest rates, it gets cascaded down through the commercial banks. Commercial banks being the banks that you see on your high street, on your main street. In Australia would be Commonwealth Bank. It could be NatWest. It could be etc. Depending on where you are. Now, if the bank is deposit heavy, what that means, as in they have more deposits than they have assets, then those deposits, they will get a higher margin for those deposits. And generally, that will translate into higher profits. So high interest rates generally, on the balance of it, will mean higher profits for banks. Now, on the flip side, then higher interest rate will also make loans more expensive. Now, that would mean that the margins on the loans typically get squeezed, so they make less from their loans, your credit cards, your mortgages, your personal loans, etc. And the what we call bad loan provisioning, as in the percentage of people who might default or might not able to repay your loan will go up because the interest rate has gone up. You might not be able to afford it, and therefore you default on your loan. So that offsets a little the increase in deposit margin. So, but on a whole, banks typically benefit from a high interest rate.
Yeah, I would agree with that. I think a nuance is that, like in Australia, that has been the case until about end of last year, beginning of this year, with the net interest margin, which is essentially the spread between what a bank makes on their loans and what they pay out on their deposits, that has peaked in around November or so. And, the reason why is because we've seen increased wholesale funding, which is a cost for the bank. So, as you said, if they're a bit more deposit heavy, well, it depends what deposits. It could be retail, but if they do have
That's a good point. Yeah.
if they do have a bigger wholesale funding source and that increases, then that's going to eat into their net interest margin. So, yeah, every bank has different funding sources. But also a development in Australia is that there's been a big competition for home loans or pricing of home loans. So a lot of banks have been pushing down the headline rates on these loans in order to get customers, and there's also cashback offers as well, so that people are switching between banks to the lowest home loan. But there's obviously a lot of catches to that, and we've seen the NIM start to pick up again. But that's a sort of nuance that I've seen in Australia. But that's all we have for today. We've talked everything about inflation rates and interest rates as well, what their implications are for mortgage holders, but also for banks. But if you're interested in more episodes like this, make sure to like this video and subscribe to the channel, and also leave a comment down below if you had any questions, and click the bell notification to keep up to date with our channel. But without further ado, we'll catch you in the next one. See ya.